And initially there was a barrage of questions which was just reflective of your anxiety. And as you have settled down with your questions, increasingly, I'm continuing with this helpline for coming weeks as well. My focus will be to explain you how things work, how we think at Value Research, and how we help you do things with Value Research Online, Value Research Stocks, our methodologies. You have a lot of questions. When I look at the number of questions, though, it is also a reflection of we are not very good in terms of having the methodology or the documentation or the help which should be available handy while you are using the website. So you should not be asking many of those questions. So we are trying to, I'm looking at it as a very pure, basic, pure feedback. So keep sending your questions. It helps us improve our services, and we will try and do as many things possible so that the obvious basic question which you ask, there should be enough empowerment, or there should be enough enablement on the website itself, explanation then and there, so that you don't have to ask those questions. So let me start with this. So I'm just trying to emphasize that if you have any question about the methodologies that we follow, the returns we calculate, how to use those returns, I'll be very happy to answer them. How our portfolio manager works, what is the thinking behind Value Research Stocks, what will be the basis of the recommendation that you'll soon see in Value Research Premium account. All those things will be very handy. And many a times I know that I just might be repeating things. At the same time, many of those questions have been asked before, but many times I understand that many times people ask these questions so that they get a reaffirmation. So I don't mind that. Keep asking your question for which you need a reaffirmation as well. Let me start this session with many questions that we got about our services. Ganesh Siv Prasad is asking that in the previous session, it was stated that it is necessary to commit substantially large amount to best buy stocks of VR Stock Advisor. Would a monthly SIP of 30,000 to 10 stocks for 2 to 3 years be fair? The ability to closely monitor and buy in dips hasn't happened in the last 1 year. I would say that 30,000 rupee to be invested for next 2 to 3 years, to be invested for 2 to 3 years. But I think, when investing in stocks, you should have a longer time frame. And I think at least 5 years to begin with, and maybe even longer. Maybe, after 5 years, you don't need all your money. 30,000 rupees per month investment should be good enough. And when I was answering that question, I was primarily looking at, the cost of this service. And if the cost of our stock advisor annual subscription itself turns out to be, substantial part of your annual investment, it may not be worth it. Maybe your mutual fund SIP will be good enough, because that is also a cost, mind you. If you have this thing in mind that you are going to invest for many years, and you are going to invest over the next 2-3 years only, 30,000 rupees is good enough. And ability to closely monitor. Of course, we have enabled, your ability. We are going to supplement substantially. All our analysts are on their toes. We have late night discussions as well sometimes when something we get to know about these companies. If we need to send you an update early in the morning because something dramatic has happened to a company, and it has happened on 1 or 2 occasions, we do that. So we are at your service when it comes to looking at these companies closely and trying to inform you of any meaningful information which requires you being alerted about that. Buy-in dips hasn't happened in the last 1 year. No, we had the mother of all dips that happened in the month of March. And that is the time when we had a lot of our recommendations which got turned into watch list, because the market was at a level, was at such a high level, or it was such a elevated level, or valuations were not attractive, that we stopped making recommendations for those previous 4 or 5 months. So many of those watchlist stocks, they came under the radar, they became cheap. And in fact, to our own surprise, 2 of our stocks have actually doubled since uh, nearly doubled, or one of it has doubled ever since the price recommendation that we made. So, stock advisor tries to give you, have filter the quality stock based on the standard stuff, which is a company which is growing, a company which is credible, a management which is trustworthy, and it is poised for growth in coming times. There are economic headwinds, tailwinds to support that. Besides that, but then we keep looking at the valuation. Today our watch list will be about 20-25 stocks. We are ready with the recommendation report, we are ready with everything, except that we don't find the price attractive enough to recommend even now. So go ahead with your 30,000 rupee annual investment for next 2-3 years with many years of investment in mind. Gigi Sunil Jacob is asking that when COVID cases were around 500, Sensex was at 26,000, and when cases shot up to 12 lakh, the Sensex is almost 38,000. Will Sensex ever catch up to the earnings or fundamentals? Does a value investor continue to invest, or is it more prudent to wait? I really don't have an answer to this question. I'm myself surprised, and 2 weeks back, the SEBI chairman was surprised. He actually gave that exact expression, that he's perplexed by the individual investor, retail investors coming into the market in such large number. Today I saw in the newspaper that RBI governor is questioning about or talking about the complete disconnect between the economic outlook and the behavior of the market. So I agree with you. But it is very difficult that to guess that when the markets will correct, will it correct, will there be a time correction? But the market, and we also understand the reason. There is liquidity. Many investors have the time now which they never had before to buy into stocks. I also find that, so this is time to, formulate some rule for yourself. If you actually, wait for the correction, you just might wait forever. Have some rule, frame some rule, articulate it for yourself, put it on the table, write it down, put it on the table, wherever your study table. Remind yourself that, okay, this thing happens, then you will invest, assuming that you have 1 lakh rupees with you. At what point you will invest 25,000? At what point you will invest the remaining another 25,000? Or at what point you will invest the remaining 50,000 that will be with you? What are you waiting for? Because if you don't formulate these rules, you'll keep waiting forever. The other thing is that once the market corrects, then we get fearful that it will fall further. If it goes up, then we have the regret that, okay, it hasn't gone up. And then if you don't buy, you don't get anything. You are not, you are not losing anything, and you will not be part of the growth. So, and stock advisor will give you the recommendations, where to go. So go with this, formulate your rule and follow it. Make sure that you are not likely to need this money for 5-7 years. That is a time frame when your investments will fructify. I don't think economic fundamentals will catch up very dramatically. There will be exceptions. There will be few companies. There will be 50 companies, which will be outlier. But majority, a good part of the economy will it will be a long drag from here on. So formulate your rule based on valuation and act accordingly. Kiran is asking that, is the Indian market ready for ESG funds or ethical investment option? And if so, where do we see the trend going in coming years? COVID-19 situation has shown markets need to pay attention to ecology as well. Yes, absolutely, but market is, the dominant part of the market doesn't really care. In India, ESG has not taken off. But Indian markets are substantially affected by ESG in a way that foreign investors have their substantial, invest heavily in India. A good part of the foreign investment has the ESG mandate. So we find very clearly that the PSU stocks or the oil stocks or the bellwether ITC, that is one of the big objections, that here is a company which is sound on many parameters, but ESG funds or ESG allocation coming to India does not buy ITC, or many of the public sector stocks, or many of the metal stocks. So I would say that it is already having a bearing on Indian market in terms of investors' preference for such stocks. And it might take some time for and once there is an investment performance, then it becomes a self-fulfilling prophecy, in a sense that people buy the ESG mandate, buys those stocks and ignore those stocks which do not comply. And so for Indian investors, it may not become a mainstream way of investing. But once they have the performance, two funds have already started. And once they deliver returns and it looks little better than most others, then it might take off. But as of now, it is having a substantial bearing on the preference of the performance of the stocks. In India, it is not a mainstream way of investing today. Manas Ranjan Nayak is asking a very difficult question. When I start an SIP for any mutual fund, I usually start with a 5-star fund. 5 months down the line, it becomes 3-star. What is your advice here? Should I stop the SIP here and withdraw all money? I don't think, our star rating is very volatile. But still, the star rating, despite not being volatile, it will slip from 5 to 4. I don't think there is much to worry. 5 to 3, 4 to 3, also not much to worry, except, take a closer look. Look at rating. The way I use my rating is that my investment universe is sometimes 5-star and 4-star funds, sometimes also 3-star fund. But definitely 1-star and 2-star fund on a 5-year rating scale for funds with over 5-year history definitely is the avoidable one, because it has been a sustained underperformer, and that should be avoidable. So I would say that stop there. Look at things. There have been funds which did very well. They were 5-star for a long period of time, then they slipped to become 4-star or 3-star. Slipping below 3-star is something which is definitely a big red flag for me. It can prompt me to act. And I'm a little surprised that in 6 months' time a fund slips from 5-star to 3-star. That usually doesn't happen, but I'll still look at our numbers to look for this particular fund where it may have happened. And I would say that rating slipping below 3-star is definitely a cause to worry. At 3-star, you have to see that because this rating is, you have to understand there are two things to it. One is that this fund has, a 5-star fund has typically done better than its peers. And so it definitely, a rating should be considered in a sense that it is a scale of, or it's a measure of relative performance compared to volatility. If you are not very uncomfortable, and then you have to see that, whether it has slipped because of volatility or slippage on return. If it is on account of volatility, then you will find that the performance number is there, but it has still slipped to 3-star or 2-star. I think that is less to worry, because that you can overcome the volatility by holding period, and that normally is 5 years and more. So if you are a long-term investor, it doesn't matter as much. But if it drags because of slippage on performance, relative performance of the fund has declined substantially, then you should definitely consider. So look at it in conjunction with the return as well. And slip below 3-star should be a big red flag. Vinod Miryala is asking that where are gold price headed? To be honest, I don't know. And I did not know 1 year ago when everybody, it would have been very profitable to know where it is headed. And from here on, the bets are off, because it can go up a little further, and it can go down substantially. So look at your risk return equation here. The best time to invest in gold would have been, if at all you succeeded in perfectly timing it, it was a year ago. It could have been, even at the beginning of the year, from where it has gone up by 50%. But where it is today, I think, little stability, little semblance, and gold is no longer that stable asset class which historically it has been, because of the financialization, because of a lot of investors are able to buy it in the paper form. People buy it aggressively, and people also sell it aggressively. And if people sell it very aggressively, if interest rates stabilizes, if market stabilizes, or the outlook for market stabilizes, then money will move out from gold. And in that sense, the risk return, equation is tilted against gold at this level, but it can still go up. Pratibhan Parthi is asking that I assume that debt funds are good in deflationary environment. If I am correct, what type of debt fund would do well during the times of deflation? Deflation meaning, no, I think nothing is good in a deflation. But I would say that yes, if we have a interest rates outlook whereby it looks imminent, or it looks reasonable to think that the only way the interest rates will go is down, then debt funds tend to benefit, because these debt funds, all debt funds which are holding securities with longer maturity, long maturity bond fund tend to benefit the most when interest rates go down. And that is what you would have seen so far. Last 6 months we have seen the successive rate cuts, and you find that 18-19% return coming from gilt funds. That looks quite unreal, while everything else is struggling. Here is a category of debt fund which is doing well. Not only it is doing well, it is also ultra safe in a sense that this whole crisis was also coupled with a credit crisis. A lot of companies, we became fearful about them, their ability to repay the interest and principal on time. And that is when, government bonds don't default. And that is why they are that particular risk not being there. Besides that, and your ability, we don't have long-term corporate bonds, but you have long-term gilts available. So this was the only way, and these funds benefited a lot. They can benefit even from here on. If we have some more interest rate cuts coming our way, then these funds will go up. So these are the vehicles which will benefit. But at the same time, you have to be prepared that interest rates are cyclical. When interest rates go up, then they also fall dramatically. They lose money. And that is and the onus is on you, that if you are actually entering it, benefiting from it, then you have to be prepared to take your money out before interest rates start going up again. Prashant Balachandran is asking that, yes, we have been talking about a withdrawal rate very often when it comes to supporting your retirement income. And he's asking that why or how do you suggest a 6% withdrawal rate? Have any studies being done in India using Indian market data? Does the 6% withdrawal rate work for 30 plus years? Is it for 50-50 allocation as in the original Trinity study? This was our study. It was a cover story of Mutual Fund Insight. And this is where we realized that, 6%, because globally the Trinity study actually refers to 4%. And 4%, and this 4%, 6%, 8% is that, if in India the interest rates would have been about 11%, 10%, which historically a few years ago it used to be, then even a 8% withdrawal rate would have been okay, because then so it is all in line with the inflation, the risk-free return that you get from fixed income, and then the potential reward for the risk that you assume by investing in equity. And it is very simple. What is the general expectation of return on my investment? And you take a part of it, leave a part of the gain so that it can compensate for the, adjusting your capital for the inflation. If you do that, you don't run the possibility of, consuming your capital, outlive your savings. So 6% has worked very nicely so far. Looks reasonable, and it is based on an allocation to equity of 65% and 35% to fixed income with an annual rebalancing. If you do this, then 6% and the money is able to, because we have two goals here, we have two hurdles. One is to have need for income which is getting adjusted for inflation. So if you 6% is good enough for you this year, then your 6% on a larger capital should be there to support the need for higher income next year, and which means that the return on your investment, which will remain as your investment, should grow in line. Your capital should grow to support a higher income. So, and we have assumed, you know, a return ranging between 9 to 12%, which is able to support that. So sometimes you will be consuming half of your returns. Sometimes you will be consuming less than little more than half of your return, from a 65% allocation to equity, 35% to debt, which supports that. If in future interest rates go down and inflation comes down further, then this 6% can well become 5%, can well become 4%, or or the other way around, it can just really go up. But it is entirely and this is where you are taking things in your control. So my suggestion will be that 6% is good enough, and be flexible about your not 6%, but in years when your investments values go down, keep 6% of that lower value. Lower your income from if you keep building some flexibility in this, or if you have headroom to actually adjust your income requirement, 6% should be good enough to support and leave a reasonable state even after. So it always assumes that you are not going to consume any part of your capital all through. So it can well be sometimes more than that. The only risk is that your capital, by the time you don't need the money, will not be as much, will not be the same. Ramesh Sangepu is asking, how frequently do you review best buy stocks? Can I assume that a stock is always considered buy at any price, for instance? Oh, it's a very interesting thing. Can I assume that a stock is always considered buy at any price? Oh, this is an acronym I'm coming for the first time. For instance, SEBI ordered divis to pay fine for insider trading, but the stock is still on the buy list. I'm an active member of VR stocks. Yes, I would say that all the funds, all the stocks on our recommendation list, except for the ones which are put on hold, and of course we recommend some sell. We have made some sell recommendations as well, are good to buy. But I think the best buys now are the most attractive of the set of stock that we have recommended. So you have three questions. How frequently do we review the best buy stocks? Every week. We take a look at the best buys list every week. We debate among ourselves, and we debate very hard in terms of does it require, but we don't want to take the best buy list beyond 15 stocks, because it nullifies the whole objective. We are just trying to reduce your selectivity. So, and even 15 is not something which which is pre-stated target. It can well be 12, 13, 10, 13. So these are the most attractive from our recommendations, which is in the best buy list, which is a combination of all weather stocks or something. Doesn't matter. Best buy is good to buy right now, relative to all other recommendations. I would say that every stock on our recommendation list is buy at any price, because when we come across a price which is not good to buy, we will recommend sell, because we will recommend sell on a stock on two grounds. One is that the hypothesis has changed. We expected the fund company to behave in a certain manner, and it misbehaved, or it is falling short of our expectation. It is not able to match the bar that we set or we expected that company to, and so we give up. And our sell recommendations mostly recommend that. So far, we haven't got an opportunity for the second reason, that here is a good company doing well. We have succeeded. It has gone up. And it has gone up so dramatically that at this price, if we have to take a fresh look that will we buy this stock, and if we think that we won't buy this stock at this price, we will recommend a short-term sell. We will recommend a sell, and short-term, because there is a possibility that we may lose this stock forever. But at the same time, we think that there is something which has changed with the company, but that will not happen easily. And in the last 2.5 years, little less than 3 years since we launched the service, we haven't got that opportunity. There are stocks which have gone up by 50%, 100%, some of them. But we have, they haven't come to a state where we can say that, okay, it's all done now. I don't think this will be a dramatic gainer from here on. No such luck yet. Yes, as of now, you can buy any of the stock which you like. For me, it is like forced retirement at the age of 53, as I lost my job due to the current situation after 28 years of career. My portfolio was 70% equity along with some hybrid, within which mid and small cap is 40%, which is heavily impacted. And my portfolio is down 23%. What is the way out? Quickly do something about it. Take a look at, set up your portfolio at Value Search Online. Look at your asset allocation. 23% down from the peak value, but I don't know. First, you have to figure out that how much is the essential income that you require from your investment. Because you may not be able to derive all the income that you used to earn while you're in a job. And also, the dynamics has changed. Before you lost the job, you had no reason to look at your investments or redeem your investment or sell a part of your investment to support you. But if you have made your investments, now it needs to support your income. So maybe there will be a need to change the allocation. Maybe you will have to change some of your investments. I would say that keep it about 50%, 55% equity remaining in fixed income. That way it will become relatively more stable. Don't worry about the decline in small cap, mid cap, because and start drawing your income from the fixed income portfolio. And then I don't know if it is not enough. If the income from your investment is not good enough, I don't know the scale of investment, and I also don't know what is the scale of income that you require. So it requires some careful assessment. But these are the outline. This is the framework on which you should operate. And if you don't have enough investment from which 6% withdrawal will support your income need, then maybe it is time to look for your job. Also, reduce your income expectation with change in some lifestyle. And this is the bad news that you will have to grapple with on your own. Sanjeev Sinha is asking that I am about to sell a plot of land for about 1.5 crore. I don't want to invest it again in real estate, considering all the negatives of real estate investing. How best can I invest this money for long-term capital appreciation and wealth protection? Equities, should I invest in equities? And how to avoid capital gains tax? One is that if you're going to sell it for 1.5 crore, you have to see that what will be the capital gains tax liability. Capital gains tax liability can be overcome, or you can avoid that only by investing in capital gains tax, capital gains saving bonds, and they yield low return. But at this point, you can well consider a part of it. It comes in two formats, where you can invest the gains or where you can invest all the money. But at the same time, the capital gains on land is paid, or the liability of capital gains tax on selling of land is after indexation. Also, you are not liable to pay any capital gains tax if you are selling your ancestral property. So just figure out when you are selling, how much you bought for, how much you are selling for, and calculate that and then prepare accordingly. I would say that investing to build wealth and for capital preservation, and if you have some experience in the market, if you understand the cyclicality of the market, I would say that you can well go very conservative with a 60-65% investment in fixed income, 30-35% into equity, can still beat, you can well pay the capital gains tax, and the return on your investment on a portfolio like this can beat the return, because no investment strategy should primarily be focused on saving tax only. Look at it with a very open mind, that what will be the capital gains tax that will be payable. Can you pay that tax and invest your money with complete freedom, which will actually translate into substantial buildup of your asset, your capital, and you will be left, you will have more money despite having paid the capital gains tax. But first look at these 2-3 things, that are you liable to pay? Swarandeep Bakshi is saying that could you please highlight the importance of net current assets and how we should interpret those numbers of a fund? Net current assets. Is it problematic if a good fund also has a negative net current assets? Okay, net current assets. Once in a while, some of the debt funds do borrow money. They borrow money if more investors are coming to take their money out. And in mutual funds, you don't have to worry about the net current assets, in the sense that SEBI rules do not permit fund companies to, investors don't bear the cost which is more than the return generated by the fund. So even if it's high, it's the AMC's problem. But it is generally a sign. I would look at it as a red flag that this fund is facing redemption pressure, and that is what is causing a negative net current assets. Venkat is asking that I have invested 9 lakh rupees in via value research stock recommendations for the last 3 years gradually. Now my portfolio is 15 lakh with gains. Oh, congratulations. So your 9 lakh becoming 15 lakhs. It has beaten our value research stock recommendations generally. So congratulations. And I want to take out 3 lakh urgently for my needs. Which stocks to sell? Gaining ones, losing ones, or rupees 3 lakh equally and proportionately? It's a good problem to have once you are still sitting on gains. And I would say that, I would have suggested you to sell your losers, sell your winners part of it. If some of our gainers would have, run away substantially. But in the last 2.5, close to 3 years, some of our winners are actually, doubled or little more than doubled, or even more than that. But they have not attained their full potential. So they have long way to go. They are in for a long innings and long rewarding innings. So don't sell your winners. Should you be selling your losers? No, our lousy losers, we have made the sell recommendations. And some of them have been put on hold. So if you have any of those stocks, some of those stocks are still profitable. The ones where we have made the sell recommendation, definitely sell them. We have some stocks which we have put on hold. If you have any of those stocks which have been put on hold, and of late quite a few, because we think that the economic climate has changed, which might be very difficult for them, maybe sell them. You still might be sitting on gains there. And after that, sell your losers, because losers might take time to make the general outlook or earnings outlook for many of these companies. We still think that all the recommendations on our list are very high quality companies. There is not much to worry except 1 or 2 which we are watching very closely, or because their environment is changing very rapidly. But most of them are worthy of being held for a long period of time. But today, if you have to sell the stocks which are on hold. After that, sell the ones which are your losers in your list. And congratulations once again. I'm 43. Deepak Kumar Bagga is asking that I'm 43-year-old, salaried, residing in my home. I want to buy another flat to upgrade my accommodation. How do I calculate how much to spend for buying new house without compromising on my goals such as retirement, child's education, and marriage? Question 2, is it right time to buy property? This question is not pertaining to is it the right time to buy property. You are basically trying to upgrade your home. You live in a 2 BHK apartment and you want to upgrade to a larger accommodation or better accommodation. So you are looking in terms of, enhancing, upgrading your accommodation. So I would say that this is not a property investment for you. You should look at it in terms of what is the cost of the upgrade and what will be the recoverable price of the house that you are living in. And the difference, can you really afford it? And can you really afford it without much of a difficulty? And if you need to borrow money, is it fine? Yes, I would say that, if you're assured of your career, if you're assured of your job that you won't lose your job, you are assured or you are reasonably confident that your career will keep progressing nicely, even from here on with your earnings potential, then carry on. I think, if it fits into this budget, then don't even worry about, any investment that you're making for your retirement or your child's education. Keep this completely independent of that. And if you're going to substitute the two houses, just look at the difference that you need to finance. Dinesh Kumar Maurya is asking that smaller AMCs have delivered superior returns than big AMCs. Should we invest in schemes of small houses or only schemes of big fund houses to deliver better returns? I'll be looking at this question. I will be looking at this question as an idea to validate that is it really true, because my sense is that primarily, HDFC and ICICI, some of the big funds are struggling or relatively disappointing compared to other funds. But that does not really make us think that, or we can't really postulate this theory that big companies are not doing well or small companies are doing well. I would say that smaller funds hold promise. And when a fund turns big, sometimes they struggle, and they definitely struggle if the market is generally not doing well, because for the big funds they have to necessarily invest in big stocks, and for the big stocks, if you have to derive your return, then the overall market should really be going up by leaps and bounds, which is not happening, and it has not happened for the last 3-4 years. And if the fund, a big fund, has to invest otherwise in a relatively cheap stock which is completely out of favor in the market, then they have to wait for the complexion to change, that when the market will notice when those stocks are relatively cheap and everybody starts buying them again and they go up. And that has not happened in the last 3-4 years. So I would say that look at the fund size. There are large funds where there are large fund companies where there are small funds which are still doing well. So I would look at it like that. And in a certain category of fund, I think big might not be an advantage, but generally big is bad when it comes to managing funds of mid-cap funds and small-cap funds. So avoid them. Devang Dalal is asking that in the present scenario, what return should be reasonably expected in various debt funds? Which category should be avoided and why? I would say that it's not about category. Of course, you can do without many of the categories. For example, gilt funds will do well, but then you have to proactively get out of them before interest rates go up, because there might be room for rate cuts even from here. I think across the board, all kind of high yield funds, all kind of corporate bond fund, or even short-term maturity funds, shorter-term bond funds, they have investments in corporate bonds. I would say that keep away from any bond fund which has modest and even modest or meaningful or reasonable allocation to anything which is AA and plus, AA and below. Not that they are bad investments, just because Indian bond funds are facing a different kind of crisis. Indian bond funds, even if they invest in high quality, relatively lower rated bonds, whenever we see a risk aversion, whenever we see that there is panic in the market, investors run to take their money out, and that causes a big problem. It is not that the funds are invested in bad bonds. It is the behavior of investors which forces the fund managers to redeem their investment in such a hurry that they get stuck. And then those funds get a big hit. So I would say that funds with larger allocation or even modest allocation relative to others, if they have allocation to AA, lower rated bonds, keep away from them, because they can face the stampede. So one has to really work towards avoiding a fund which has the potential to face a stampede, because stampede is the real risk, not necessarily the credit risk. So Paresh Mistry is asking that given the prolonged pandemic and the fact that it may take another 6 months for vaccines to be mass produced, is there a likelihood of liquidity challenges re-emerging? Is it advisable to park money in debt market funds given the equity market is volatile? Yes, it could be 6 months, it could be 9 months, it could be 3 months, I don't know. And it could linger, because we never expected it to linger the way it is. So, and we still have a lot of things which which we can only guess. We can't really be sure of how it will pan out. So I would say that be a little wary of this. But you should have a plan which is independent of what happens to the environment, because we have absolutely no control on the environment, but we have a reasonable control on what happens to our money when we need the money. There will be money which you don't need for 5-10 years, and there will be a part of money, or you will have your estimates of the money which you need every month, the money that you are likely to need in next 2-3 years. Keep that money in fixed income, and the money which you should always have handy, so that you have a nice sleep. And that is called, the contingency fund or the emergency fund. And you are the best judge. You can only do the best estimation of that. So, and if you have this plan, nothing else matters, because after that, if it takes 6 months or whether it takes 1.5 years, it doesn't matter. Then about your long-term allocation, should you be fully invested in equity? No. You should have, every long-term investor should also have some fixed income allocation, whether it be 10%, 20%, 30%. And if you are really getting concerned about it, maybe 10, 20, 30 can actually become 15, 25, 35 to fixed income. This is a long-term portfolio. So you can tweak it a little bit, but don't try to act in a huff. Don't try to, get out of equity and then you will try and time it. You will get it wrong. You will be caught on the wrong foot, and it will be extremely disappointing. We have come across, mails, in the helpline 2 weeks back, we had a question where somebody had exited sold all his equity funds in a hurry, and then he was regretting it, and now after you get out and you get it wrong, then you have deep regret, and then you are thrown out of the market. And you will be scared to get out of it again. You will have deep regret once you buy it again after 30% gain or 40% gain. So you end up selling low and buying high, which is a disastrous thing. And that can be dealt only with this plan in your mind and a discipline to implement it. Rajiv Kamath is asking that I have been posting this query for the past week. I hope I'm lucky this time. I had a SIP in Reliance Gold Fund, which I have stopped more than 3 years back. Would it be a prudent strategy to redeem from this fund and invest the redemption proceeds in sovereign gold bond scheme? Yes, I think so, because, as I explained in the last, a few weeks back, or maybe the last week itself, that all the forms of gold ownership comes with a higher transaction cost. Gold bond is the only, or, some transaction cost or expenses. Sovereign gold bond is the only one which will actually ride the gold prices, and it will give you 2.5% return, and in a tax efficient manner, in fact in a tax free manner. So I would say that yes, if it has accumulated into something sizable, and if you think that you have the patience to hold these sovereign gold bonds for 8 years, then by all means have it, change it. If you don't need the liquidity, by all means do it. A.S. Khanvilkar is asking that it is said that tax rules applicable to balanced advantage fund are the same as equity funds. Please elaborate whether this is always true, and if only in some cases, then how to confirm before booking long-term gains. Oh, there is a very simple way of confirming it. Just check that if there is going to be a securities transaction tax on the when you redeem it. If there is a STT paid on your investment, it will be treated as equity. And balanced advantage funds were actually devised as a tax dodge only, because the differential between equity and bond fund treatment was very different. Equity used to be completely tax free earlier, and debt fund investments used to be taxable. And but it is no longer the case. Today you pay 10% tax, capital gains tax, even on your equity investments. So that might be beneficial as compared to debt fund kind of treatment, because there you have to hold it for 3 years and then the money will be indexed. But if you are going to hold it for 3 years, sometimes the indexation and 20% tax on indexed value might be more favorable as compared to 10% flat capital gains tax. So it is the interest, the tax differential or the tax arbitrage is no longer as it used to be. But most balanced advantage fund were devised in a manner that they used to have 30 to 40% into equity, 30-40% into fixed income, and the remaining in equity arbitrage to give it the complexion of an equity fund. And that is how they were configured, and they continue to retain their design and structure to be compliant for this tax law. Abhijit Bhosle is asking that I wish to understand more on investing in mutual fund and how to select the best mutual fund schemes. Good mutual fund is the one which goes up with the market a little better, little more, and which goes down a little less when the markets crumble. And if it does it over a full market cycle, which means the phase of the market when the market is going up and going down, then you end up being a winner. And this is done by a person called, who is a designated fund manager. So when you are looking for a fund, don't look at last 6 months return, 1 year return, 5 year return. Look for the return in the rising phase. Look for the return in the falling phase, and look for this check, that is it doing better than the category average. And all these numbers will be available on Value Research Online. You can also look at the graph and of the category average and the fund itself over different time period by selecting the date. You can look at it visually too. And you can also check whether the same fund manager, because if you have seen that a fund has done well in a rising market, and if a fund has also done well in a falling market by falling less relative to others, then you have to see that the same fellow who has done this is still there. And once you find these two things, and mind you, what I'm saying you might be sounding very simple, but it is able to reduce a substantial number of funds from your universe. If you will look at 100 multi-cap fund, and if you test these funds on these variables, you just might end up with just 5-7 of them. So look at it carefully, and you can do it yourself. Dinesh Lavate is asking that how much international equity fund allocation should we have? Also for true geographical diversification, how much and which country specific international fund should we hold? For example, US, Japan, Asia equity funds. I would say that, the idea, I have approached it in a very limited way. Finally, you should have a collection of businesses which is likely to or has potential to deliver you substantial growth and return over a period of time. So from that standpoint, you will have a large part of, we all have our home bias. Our job is here, our home is here, and our investments are in India. So look for those great businesses, or look for a fund which will be investing in those great businesses. So most good growth-oriented multi-cap funds are attempting to do that. So choose your multi-cap fund. I would say that, Japan has been an extremely rewarding market in the recent times, but it has been a big struggle over a very long period of time. And Asian equity funds, you don't know what you're getting into, because it's a big, the kind of investment avenues available to Indian investors through funds is different. I like the US funds simply because of their technology bias. I look at them as, technology fund with a global market. And I also don't look at them, I think of them as a US domiciled companies, but they are not necessarily US companies. When I look at Facebook, when I look at Microsoft, when I look at Amazon, I don't think of them as US companies. They are stationed in US, they are domiciled there, but they are not, their market is all over. Their revenue is coming from investors all over the world. When we are watching YouTube, Google is making money, the Alphabet Corporation. Or when you are using the Windows, Microsoft is making money. So they might be, Apple's substantial revenue comes from market elsewhere. So the technological lead, or lead driven by innovation and a global marketplace, and particularly the technology as a business, has evolved into something which has created a very unusual thing. The winner takes it all, the phenomenon which is visible here. In all other industry, we see that There are businesses which compete, and the profits in that particular sector or in a particular product segment is shared by some. In technology, we find that the winner actually takes it all. When you buy a PC, it must have Microsoft Windows, and there isn't a number two. Of course, there are alternatives. There is Linux, there are freeware, there are open source things, but majority goes with that. Likewise, for many other products, they try. The winner dominates the marketplace, and that is the nature of the business. That's the nature of somehow that has happened, and that has become the rule. And it is not absence of competition. I really wonder that there will be an easy competition for a Netflix or a YouTube. Of course, there could be. Despite all that, it changes. But the dominant position which they derive, which is entirely driven by innovation, is quite mind-boggling. And the rewards of such innovative successes is something that is unthinkable. The kind of rewards it creates for the investors. So I would say that NASDAQ 100 gives you a very simple vehicle to derive a part of that story. It is also possible for Indian investors to invest $2 lakh, $200,000 US dollar equal worth of investments anywhere in the world. And buying US stocks has become very simple. You have stockbrokers who are making you available an opportunity to buy stocks in the US market up to $2 lakh a year per person in India. That is our tax law. That is our entitlement. So you can buy those stocks and with zero brokerage. So just don't get attracted to these things for zero brokerage. But if you want to implement this, it is all in the realm of possibility. You can do all of it yourself and selectively apply your common sense, read something, and not very soon, but we plan to expand the coverage of value stocks in a limited way to some of these international stocks as well in near future, and we are working in that direction. But it is some time away from now. It might take a little longer because we really need to build capability, and we definitely will be very selective in that. But this is the primary thinking which is driving us to think in that direction. So thank you very much for all your interesting questions, and I'll be back again with the helpline. As I suggested in the early at the outset, that I'll be very happy to take more questions about the methodology, how we think, how we do it, because I don't get any other avenue to talk to our users directly the way I do every Saturday. So thank you very much once again for being here. See you next week.